The Vanguard FTSE Emerging Markets ETF, known by its ticker VWO, is one of the most popular ways for investors to gain exposure to developing economies. It is a simple, low-cost fund that holds thousands of stocks. China, India, Brazil. For many, this ETF serves as a core building block, diversifying beyond US or other developed market stocks. The fund aims to track the FTSE Emerging Markets All-Cap China, an inclusion index which provides a broad and comprehensive measure of stock performance in these growing regions. Simplicity and accessibility are key features made VWO a staple in countless investment accounts. The fund's size tells a story. Market capitalization: $137.2 billion. This scale means high liquidity, easy for retail and institutional traders. Its purpose is straightforward: give you a piece of faster-growing economies. Designed as a long-term holding capturing global economic shifts in a single, easy-to-trade security, investors often look to emerging markets for higher growth potential. VWO has delivered recently. When you look at the performance of VWO in 2025, the numbers are impressive. The fund has delivered a year-to-date return of 24.9%. That figure stands out in any market environment. It has even outpaced the S&P 500 by nearly 10 percentage points this year. The one-year return is 17.8%. These figures highlight renewed strength for emerging markets. They had lagged US stocks for several years. Such returns can attract attention, drawing in new investors seeking growth outside developed markets. Past performance does not guarantee future results. Every investor should keep that in mind. One report shows a 5-year return of about 7.75%. That more modest number provides context. It shows investing in emerging markets requires patience. There can be extended periods without exciting returns. The strong 2025 returns are part of a larger cycle. Understanding this sets realistic expectations. Don't chase recent hot performance. Understand the long-term role VWO can play in a portfolio. The fund's massive size is a key data point. Assets under management reported at $102.9 billion. Assets under management reported at $137.2 billion. Beyond just the potential for price appreciation, VWO also provides a steady stream of income for its investors. The fund pays dividends on a quarterly basis, which can be an attractive feature for those seeking regular cash flow. The current dividend yield is reported to be in the range of 2.79 to 2.83%. This is a respectable yield, especially when compared to the often lower yields of broad US market funds. The annual dividend payout is listed as $1.53 per share. For long-term investors, reinvesting these dividends can be a powerful way to compound returns over time, significantly boosting the total return of the investment. The next dividend payment is an important date for income-focused investors to watch. The next scheduled payout is expected to be $1.07 per share, with an ex-dividend date of December 19, 2025. This means an investor must own the shares before this date to be eligible for that specific payment. The previous ex-dividend date was September 19, 2025. This regular, predictable schedule of payments adds a layer of appeal to VWO, making it a suitable holding for those in or nearing retirement who rely on their portfolios to generate income, while still maintaining exposure to the growth potential of emerging economies. It offers a blend of both growth and income. One of the most compelling arguments for investing in emerging markets right now is valuation. VWO is reported to be trading at an attractive forward price-to-earnings multiple of around 11 times. In simple terms, this means the fund appears to be relatively inexpensive compared to its underlying earnings potential. A lower valuation can suggest that there is more room for prices to rise in the future as earnings grow. For value-oriented investors, this can be a strong signal that emerging markets offer a better bargain at current levels. Finally, one of the most defining features of VWO and Vanguard funds in general is its extremely low cost. The expense ratio is reported to be just 0.08%. When you invest in a broad emerging markets fund like VWO, you aren't getting an equal-sized piece of every country. The fund is market cap weighted. Bigger markets make up bigger slices. In VWO, one country stands out: China. Chinese stocks make up approximately 29.7% of the fund. That's a significant concentration. VWO's performance is heavily tied to China's economy and politics. If Chinese markets rally, VWO likely benefits. But that concentration is a double-edged sword, the single biggest risk. On the plus side, China is massive and innovative. On the downside, it creates specific risks, geopolitical tensions, trade policy shocks. Any negative US-China shift could hit nearly a third of VWO instantly. Beyond China, the fund is more diversified. India, 16.4%, Brazil, 3.9%, Saudi Arabia, 3.5%. So returns are driven by a few large markets, not every emerging country. Investors shouldn't assume equal exposure. Demand is rising for ex-China emerging market ETFs. Example, iShares MSCI Emerging Markets ex-China ETF, EMXC. Looking at the technical picture for VWO, the fund has shown considerable strength throughout 2025. As of October 21, 2025, the price is trading near $54.98. This is very close to its $55.04 52-week high, which indicates strong upward momentum. The 52-week low for the fund is $39.53, so investors who bought in at lower levels over the past year have been well rewarded. Trading near the peak of its annual range is often seen as a bullish sign, suggesting that investor sentiment is positive and that the path of least resistance has been upward. The fund even recently posted a streak of 6 consecutive days of gains. This positive price action is supported by strong investor interest. Despite the concerns surrounding its China exposure, investors continue to put money into VWO. Diversification benefits, steady dividend income, low expense ratio, attractive relative valuation. For many, VWO remains the simplest and most cost-effective tool for the job of gaining broad emerging market exposure. Trading activity provides another view. About 9 million shares traded on a recent day, roughly $483.6 million in volume, with volume up 575,000 shares. It's not a niche, hard-to-access product. It's used by individuals and professionals alike. In summary, the Vanguard FTSE Emerging Markets ETF, VWO, remains a cornerstone seeking low-cost, diversified exposure to developing economies. Its performance in 2025 has been remarkably strong, outpacing even the robust US market, driven by attractive valuations and a broader rotation of capital into international assets. The fund offers a healthy dividend yield of nearly 2.8%, making it suitable for income seekers. Massive size and an industry-leading low expense ratio, 0.08%, ensuring it remains a go-to choice for millions. However, no investment is without risks. VWOs are clear. Nearly 30% allocation to China, fate closely linked to a single country with geopolitical and regulatory uncertainties. The rise of China excluding ETFs shows investors mitigating this risk. Inherent volatility of emerging market currencies and potential for political instability in other key countries. Looking ahead, keep an eye on China's economy and trade, fund flows into ex-China alternatives, earnings of top holdings, and price action around 52-week highs. Ultimately, VWO represents a trade-off, potential for higher long-term growth, a solid income stream, and an exceptionally low cost, in exchange for higher volatility and significant China concentration risk. For long-horizon investors who understand the risks, VWO can be a valuable diversification tool. The right choice depends on personal risk tolerance and long-term goals.